going to jump right into a webinar that we hosted on the afternoon of Thursday, August 8th. We're joined by Ted Seifert, whose introduction unfortunately was cut off by my recording, and then, of course, Brian Grossman, Dan Hussey, and myself, Mike Pearson, talking about markets and specifically talking about strategies and plans to put in place given the volatility that could come on Monday with the USDA releasing its monthly WASDE report, as well as resurveying corn and soybean acreage. So without further ado, we're going to just dump you right in to the webinar.
Yeah, it's
That's
definitely
right.
going to be one that's going to be a complete surprise for what not only just, someone looking at what the forward curves and the spreads are looking at. There is always the possibility that the commercials out there are going to get taken completely by surprise.
That's right, folks, and that is Brian Grossman, another market strategist here at the Zaner Group. Brian has been around the world. He is a farmer boy from North Dakota, and I don't know why it is talking to us, but I think that's ending, because we're not calling customer service. We're just going to power through this. Next up on the call, we've got Mr. Dan Hussey. Dan has been around as well. He has all kinds of experience in the markets. Dan, thanks for taking the time to talk with us.
Absolutely. Pleasure to be here, and great to be one of the newest members of the Zaner Ag team.
Absolutely. One of the newest being myself, folks. I'm Mike Pearson. I've been a farm broadcaster for a while, former cattle feeder, former cow-calf producer. Really excited to be here with this team. It's a great bunch of folks concerned with the markets, concerned with helping producers make a profit and maintain a profit in challenging environments. And guys, challenging environments are where we are at today, and that is something that we are going to be addressing. The Zaner Group, for those of you who are unfamiliar, I know we've got some new folks on the call. Welcome. This is some quick information about Zaner. We've been around since 1980, CFTC registered, fully certified. You can trust us. We've been around, as you can see, Better Business Bureau A+ accredited. We've got global futures expertise, brokerage and clearing, obviously risk management, and top-notch research and strategy, and that's what we're bringing to the table today. Zaner hedging. Ted, this is kind of your main spot. Tell us a little bit about what you do to work with producers.
Yeah, so, our main goal is to work with producers on a one-on-one basis and try to get to know them and their operation so that we can advise them as if we are standing with them in their field or feedlot or whatever it is that we're doing. Again, our goal is to help manage risk. We all have risk, whether we're producing grains. There's a lot of risk when it comes to input costs, but certainly the price of grains throughout the year really dictate whether we're going to be profitable or not, depending on where we make our sales. Same thing with livestock. As far as end users are concerned, obviously we're trying to buy as cheaply as we can, and we need to protect our profit margins as much as we can. So all of us that have cash exposure to agricultural markets have risk, and so we try to mitigate that as much as possible.
And we can use any number of strategies that it takes to adequately protect the grower, assuming they make sense.
Yeah, absolutely. I like to say that, we have different tools in our toolbox, right? And different occasions call for different tools. Also, I would say that different risk tolerances, in different applications, the individual that we're working with or the operation that we're working with, we may be taking a different approach than other people are because, it all kind of depends on the individual. So we try to get a good gauge on what the markets are doing and where we think we might be going, and then we try to get a good gauge on the operation that we're working with, and we try to combine those two in order to kind of dictate what tools we should be using.
Absolutely. It's a marriage aimed at financial success. Now, Ted, you mentioned we try to get a good gauge on the markets. Let's bring us up to speed. Let's kick it off to you first. Where do we sit today? Let's talk corn market right off the bat. It's been an interesting week.
Yeah.
Yesterday wasn't terribly interesting, but today we had a little bit of excitement.
Yeah.
Where do we sit?
This week has been one of stabilization, right? I mean, we've had a 75-plus cent slide off the highs that we had in mid-June, and now we're trying to find some footing and try to figure out where to go from here. Obviously, we are really sort of pins and needles waiting for this USDA report that's coming out on Monday. But for the most part, I do feel like we've had our slide off the highs. I don't feel like there's a precipitous downfall coming from here. We've had that already. Now it's just a question of, can we bounce back up towards those highs or best those highs? And that's going to depend on, what we're going to see on this report on Monday, but also very much so on weather. Are we going to see an early frost and so on and so forth? For my money, though, I kind of feel like the corn story played itself out. We might have had the bullish sort of fever pitch attitude in corn happening in that mid-June high. I'm not sure that corn is going to have the fundamental reasons to go and beat that high unless we do get that early frost or we get a significant rally in, say, soybeans, for example. And now, as time has gone on and we've learned more about these crops and what weather has been over the past few weeks, I'm starting to think that the real story might actually be in soybeans. So, keep an eye out for that. If soybeans really get going, that might be enough of a reason to get corn up back towards those highs or maybe even make new highs. But this soybean crop might end up being the real story here this year.
That's one of those things. Brian, you were talking yesterday about the risk that is there in the soybean market. We have a long month of August left ahead of us. What are your thoughts here in the soybean market?
We have a long month of August, but we're already a week into it, and the weather hasn't been the ideal, cool, wet, perfect that we've seen the last couple of years. A lot of areas, a lot of key areas, say Illinois for an example, they're very dry. Places in North Dakota are on the extremely dry side. It's widespread everywhere. I even saw some pictures today out of Ohio, unfortunately, for those guys turning dry already. So I don't think the soybeans, I agree with Ted, I don't think the soybean yield potential is necessarily going to be there this year. And granted, we could shave some more demand off of the China factor, but, our crush capacity is, still moving right along. Crush margins definitely are down, but we're still right up there near record highs on monthly crush. We have a lot of demand domestically. I think it's going to be able to, have some credence if we do end up coming in with just even 15% reduction in yield.
Dan, you've been taking notes over there. What are your thoughts here on this current market conditions?
Well, the current conditions of the crop, unknown. We at least have technical backings for short-term rallies, which I think we'll take a look at a little bit later in the call. But corn breaking above multi-day inside range there is a good constructive close today. And the soybeans taking out 5 days worth of highs, filling a gap down into the 860 area and reversing all pretty constructive price action given the current situation.
Right, and given the risk that is inherent on Monday. Now, Brian, I want to talk to you a little bit. You are our spreads guy. You've been tracking these spreads and making these charts. Bring us up to speed. A, what are we looking at? How should growers interpret these? And then what are they telling you?
So those are the calendar spreads. Like the top left is the December to March. So December 19 spread to the March 20 contract. And then the next one is December to May, and then so on and so forth. But, that's showing what the commercial interest is. Are they willing to buy up a commodity that they need right now at today's price? Is there a concern that it's not going to be there? We've had the big run up, initially during the height of the scare, like Ted said, putting in those big highs early. Even on the calendar spreads, if you're looking at it, the commercial interest simply has not been there. And if you go to the Commitment of Traders report and look to see how they're positioning, the commercial longs are holding a relatively decent sized position. They're slightly above what their normal is right now. So, the commercial longs are the people out there that are ethanol plants, feedlots, the end users. They're going to be the ones buying it on the board. And if they're not showing concern, they're either not concerned or they're getting enough form of physical commitment, whether it be from somebody has a lot of grain in their bed or they're giving an HTA. And that could blow up in faces of some people if they have over-contracted what they have. But for right now, they are getting a physical commitment. And recently we have seen them start to rally these spreads.
Okay, so I'm going to have to pause for just a second, because when we're talking spreads, a lot of growers don't necessarily think in terms of spreads. We think in terms of the price that's offered at the elevator. So when you're looking at a spread, you're looking at the difference in price between two different month contracts.
Right.
And as that price rises, what does that mean?
As that price rises, that
change
the increase in the spread between the two is a increase in a financial incentive. Is it now worth you contracting it out at that later date, getting that higher price and storing it until then? So you always hear about capture the carry. That's what you're looking for. Is it worth me carrying it all the way out till then?
So, I want to jump in here really quickly and say, a lot of times we look at spreads to kind of give us an indication of where the markets are going. But Also, a lot of times, spreads are sort of a lagging indicator. And in talking to a lot of the commercials out there right now, I feel like there is this sort of growing want and need to actually start to fill some cash needs. We've seen basis really rally pretty aggressively on this rally. Producers, for the most part, really do feel like we're going to $5 plus corn, and guys are very, very tightly holding the stocks that they do have. So basis being as strong as it has, I think, is an indicating factor, maybe as much or possibly equal to, so let's say as much as the spreads that we're watching right now. And I think that a lot of these commercials were looking for a break just like this, the seasonality of it, to fill a lot more of their needs. And I think they're out there looking for that right now. So that kind of goes along with what I was saying earlier, where, I think we found some footing here unless the USDA completely kills us on Monday. But I think we found that footing, and as long as we can get through this report without having a terribly bearish report, I think your end user is going to step up to in a bigger way. At least the domestic end user is going to step up in a bigger way to start filling some needs. As far as your global end user is concerned, obviously we've been struggling with our export sales. Part of that's due to the high dollar that we have. Part of that's due to the trade issues that we have. But the biggest part of that probably is the fact that South America had some very, very good crops. Now, we're going to be running through the stocks of South American corn and soybeans here shortly. And when we do, that business will start coming back to us. So that'll be happening right around the time we generally put in a harvest low. We'll start to feel good about our demand again coming back in. While it might not be a permanent thing, certainly temporarily I think we'll feel good about that. And I think this is a year where we're set up to have a bigger harvest rally than what we've seen in the last 4 or 5 years.
I've heard that from a lot of different folks just because the bushels might not be there. Dan, you've been talking a lot the past couple days about end users filling the pipeline. And it sounds like your thoughts echo Ted's pretty closely. Can you explain a little bit what you're thinking here as these end users are acquiring some product, getting that pipeline full on this recent setback?
Right. And these types of prices have allowed those commercial buyers to fill their pipelines at a reasonable rate, and one that they're happy to take it. However, going into a report like the WASDE in a week, my inclination would be to maybe even hold off on some of that purchasing, because I could have filled my gaps and filled my pipeline for a couple weeks out. And you can let yourself, come into a report with the knowledge that I'm taking care of for the foreseeable future, for maybe the next few weeks, and I can let prices drop after a report like this if they want. Or in the event it rises, we could see that prices having been locked in. So commercials utilizing spreads into a report like this, it's a way of managing their risk, because they have just as much event risk as any speculator does. They usually just have the physical and deeper pockets to survive whipsaws. So, but it still presents both risk and opportunity to any trader.
Yeah, so you're talking about commercials and speculators, making up the market. Brian, bring us up to speed. Who is making up the market here in August 2019?
The vast majority of the volume is going to the commercial crowd, as it almost always is. The blue lines on the chart are the speculative longs and speculative shorts, the non-commercial. Commercial, anybody that has a hand in a bona fide hedge on that commodity, whether it be long or short, or the ones in oranges. So looking at that one, even though we're coming out of a lower or out of a high peak in open interest, we are still seeing the commercial longs not really getting crazy. They're a little bit above their average. Earlier this year, when we were in the height of the scare, they were buying and actively going to the board to do it. But since then, we've seen that coming down. So either they no longer feel they need it, or they're getting it on a physical commitment.
Gotcha. And at that high, we were watching spreads try to go inverted in corn and not. And that inversion in a market is the very concept of panic buying with the fear that it's not going to be there at that later deferred date. The markets did not do that, and since then, I think, Brian, you noted we've traded all the way down to 60% full carry in some markets.
Yeah, it got to 68 the day that we reversed and started finding a little bit of a base here again.
Gotcha.
Yeah, but there's something that's kind of different in grains trading than there is in other markets, and that is that we have different crop years. So, a lot of us were looking at, like, say, the September-December spread, or the August or July-September, or July-December. and a lot of times we're talking about old crop, new crop spreads. And while there is that sort of relationship, because listen, if we're going to have a short crop for new crop, then every bushel that we have in old crop, the market's going to try to work to bring that into old crop or bring that out as much as possible. But, you know, we do have that dynamic of, hey, there's another crop coming. So, yeah, I'm with you on the spreads. I definitely think that there's something we should keep an eye on, and it gives us sort of, insight into where markets might be going. And like Dan was saying, that, you know, we never could flip inverted, but I think some of that's a reflection of the fact that we had a very big ending stocks. And those old crop ending stocks keep growing, by the way, even though we're having a hard time prying them out of the hands of the producer. But, you know, going forward, you know, I think those spreads will be a sort of lagging indicator if we're going to start to rally again. When you do see the spreads start to catch up, though, that will add credence to a bounce, in my opinion.
All right. Well, we've talked a lot about the corn market. Let's jump into the soybean market. Oh, excuse me, Dan. You've got a strategy you've been working on for the past couple of days. I want to make sure we get that out there.
Yeah, and I pointed this out on Facebook yesterday. Was that the double inside day in corn was giving a little bit of constructive price action, or something to lean on if we start to go through those August highs and the highs of yesterday and the day before. Well, today's close, we settled above these levels and might be starting that constructive price action higher. This isn't necessarily a call that, hey, corn's going to $5 or even getting back to the June highs, but the current mode of price discovery into a big report is now suggesting, from a technical perspective, corn wants to trade a little higher.
All right. We'll keep an eye on that. Now let's jump in and talk about the soybean market. Brian.
Wait.
Oh, you got more.
Are we going to do a soybean strategy?
We are.
Yeah, okay.
We are. So listeners, stay tuned.
Does somebody have a soybean strategy?
Well, we've got as many as you want to share, Ted Seifert.
Yeah,
This is your advantage working with the Zaner Group. You got three great minds willing to press the pencil to paper and solve some different issues. So stay tuned. We'll get to soybean strategy. But first, let's hit the spreads again real quick. Brian Grossman, bring us up to speed. What are the spreads telling you?
For now, the commercials have been starting to buy again. We're getting that bounce off of the low, like we're like you can see up there. But the biggest problem is we're going right up against that trend line resistance again. We're going to see how much interest is actually out there. How hard are they going to have to fight now that we're going into another harvest?
That's absolutely. And Ted, you've mentioned a couple of times just the overall concerns we have of perhaps soybeans becoming the market driver. We definitely saw a move today. We saw a move yesterday in soybeans. How much more do you think we can get to running before we get to Monday?
Yeah, how much we run between now and Monday, to me, doesn't really matter, aside from the idea that it might make it a little bit more difficult for me to get into some of the strategies that I'm trying to get into. That being said, I really, really would like to see some improved crop conditions for soybeans, but we just haven't been able to see that. So, I don't know. In my mind, when I'm looking at the soybean crop versus when I'm looking at the corn crop, I see some good corn, I see some bad corn, but I don't really see very good soybeans. I think the soybean crop as a whole is really struggling, and really when we talk about an early frost or even a normal frost, the soybeans might be the ones that really run into problems with something like that. So, in my mind, I kind of think that the soybean story might ultimately be the big story. I think there's a lot of room for the USDA to come down on soybean yield right now. Yet at the same time, I don't see a whole lot of room for them to take away from the demand side of the equation. As Brian was saying, crush, while margins aren't as good as they have been at points in the last year and a half, the crush is still going to be strong, and we're going to continue to push the crush. I don't really see a whole lot of downside. Maybe 40 million bushels is at the most is what we would cut off that crush demand number. The export number is already a very low number. Our expectations are low because of the Chinese or the trade war that we're having with China. So there's not a lot of fat to trim off of that. So if we start cutting production, you're going to see ending stocks come down very aggressively. And I'm going to say this. If we get ending stocks down into the mid 400 range, which is kind of where I think we'll end up, at that point, do we have to put a premium into the market on the idea that maybe we might get a trade deal done? Because if we got a trade deal done with only a 460 million bushel carryover, very quickly we would actually run out of soybeans. And Trump's prophecy of selling China more soybeans than we were actually able to produce might actually come true in a very lucky way, I suppose. But Yeah, to me the soybeans are a story. I'm kind of excited about some strategy that we've got going on in the soybeans right now. I'm being told that I have to wait on that. But
we got to keep it orderly.
Stay tuned.
Stay tuned.
Yeah.
Now, Brian, want to real quick talk a little bit about who's making up the market here today?
Well, we've had a noticeable shortage of what the commercials are showing any kind of an interest. They're not coming to the board, whether it be sellers or commercial buyers. They're well below what we've normally been seeing them at this time, but we have seen a lot of influence coming in from the non-commercial crowd. So at some point, if we do have a short crop here, we should see them start to get pretty awful nervous considering how far behind they are compared to normal.
All right. Well, next up, Ted. Kick us off. We got a soybean strategy you want to talk to us about.
Yes, absolutely. So I really like the January bean call spreads. And what I'm looking at in particular is the January soybean 940, 1040 call spread. I think that if I'm right about what's going on with the soybean crop this year, I think we've got about $1.50 potential for a rally in soybeans. So that put us right around the $10 January or 1050 January bean mark. So what that means is that there's an opportunity out there for basically a 1 to 10 risk-reward ratio. And this is more a speculative strategy, or it could be a re-ownership strategy. It could be a end-user hedge strategy. So again, it depends on who you are as far as, if you have a need for the strategy or just sort of a want for the strategy. But I think we can get a $1.50 rally on a 1 to 10 risk-reward ratio, paying 12 cents to make a buck. Wow, that is a fairly rare opportunity, especially in the soybean markets, because in soybeans we usually have such a large premium in call spreads because soybeans always have the potential for a rally. We've taken a lot out of that because of the trade wars. And, again, like I said, we might not need a resolution to the trade war. In fact, a resolution to the trade war in this current crop year might actually run us out of soybeans. But just the opportunity or the potential or possibility of ending a trade war and China coming in a bigger way, I think gives us a reason to put in a premium to the market. And again, I think 1050 soybeans might be a pretty, well, for me is an obvious sort of thing if we end up with like a 45 or even a 44 national average yield. So I like that a lot. I think the price is really reasonable to work with, and the potential is huge.
Absolutely, and 12-ish cents was where we're at with the price.
Yeah, I mean, we were moving around a lot with soybeans today, but I got some done earlier in the day around that price. But yeah, no, give or take a couple of cents, it's I think a really nice value out there right now.
Fantastic, Dan. You've also been plugging away on a soybean strategy. What are you looking at?
Yeah, and supporting that a whole idea of a substantial rally in the beans without any even fundamental backing at this point. From a technical perspective, this market did place some back and fill price action into a gap fill into the 860 area. Seeing 5 days worth of consolidation there and a 5-day breakout of highs, taking out 5 days worth of highs here, is a very, very constructive looking chart right now. There isn't much in the way of resistance now for beans until you get back to that $9 handle where the 50-day MA, some broken trend lines, once support, now is resistance, as well as the 50% retracement of this entire decline exists. So price discovery alone should take beans higher into this report. And like Ted said, if there's any inclination of an issue with yields, this is just the start of a perfect storm for the beans.
All right. Well, let's talk about Monday's report. Ted, I know you get asked by ag journalists around the world to share your thoughts on what the USDA could be thinking. So why don't you tell us, what are your numbers when you're looking at Monday?
Well, before we do that, I want to talk about the average trade guesses. And, when I look at corn, and I'm using the Bloomberg survey for my baseline here, but when I'm looking at corn, the average trade guess for corn carryover on this report is 1.57 billion bushels. That's compared to the USDA in July at 2.01 billion bushels. It's a 440 million bushel reduction on the August report. That's what we're expecting. That's only happened one other time before in the past, and I bet you all can guess what year that was. Yes, you're right, 2012. This is not 2012, and in fact, for the sake of analysis, we usually throw that year out because we don't see years like that aside from maybe every 30 years. So if I take 2012 out of the equation, this would be, if these trade guesses were accurate, this would be the largest drop on an August WASDE report in ending stocks that we've ever seen. Is that the reality of the situation? Maybe. Is that what we're going to see from the USDA on Monday? Wow, I don't know. We're also looking for roughly a 700 million bushel reduction in production for corn. That is a staggering number. Okay? Again, only one other year can compete with that, 2012. Since then, we haven't seen anything even come close to half of that. Or even, going back 20, 30 years, we haven't seen anything close to half of that. So I'm a little worried that the trade expectations are a little bit more aggressive than what we might actually see on this report, and we could get a disappointment. Now, that being said, look at the soybeans. There is a 729 million bushel range on guesses for ending stocks in soybeans. 729 million bushels. That is an insanely large range. Somebody is going to be surprised on this report for soybeans. And I honestly wonder if it's not going to be a bullish surprise, because everybody's kind of looking for a sharply higher soybean acreage number. I'm not sure we're going to see that. And even if we do, like I was saying earlier, I don't think we have a whole lot to cut out of the demand side of the equation. And it seems to me that there's a fair amount of people that are doing that currently. So once again, it could be a situation where we get I'm not going to call it a bearish corn report, because in my book, a 1.7 billion bushel carryover in corn would be really rather bullish. Unfortunately, though, we have these trade expectations for a lot more than that. So we might get a bullish report, but it's not as bullish as the trade's expecting, and we might get a bearish reaction to it as your algorithms, as your speculative traders who don't really know anything about really what we're talking about, respond to this being a miss. We didn't get the expectations. We came in below expectations. That's a bearish report. It's not a bearish report, but it might get treated like one. Well, at the end of the day, it's going to be interesting to see how we close. And if we get a bullish soybean report, that might help fix some things. That might be able to pull corn out of the gutter. I don't know. We'll see. I will say this. Based on the expectations that the trade is looking for, I'm not saying we can't have a bullish report in corn on its own, regardless of what the soybeans say. I'm saying that because these trade expectations are so wildly bullish, it really diminishes the chance of getting a bullish report or getting a bullish reaction to the report. And lastly, I'm going to say it again. The 440 million bushel reduction in ending stocks to a 1.570 billion bushel carryover in corn, this is not what we are trading currently in the market. It's a misrepresentation of what the market fundamentals really are at the moment. In my opinion, I think the corn market's trading something around a 1.8 to a 1.9 billion bushel carryover with a 13.5 billion bushel production number. It's not anywhere near what these average trade guesses are. So I really don't like what the analysts, and we're one of them, by the way, but I don't like what the analysts have done for this report. I don't like these trade guesses. It makes me worried about what this reaction to the report might be.
All right. Now, Dan, Brian, you guys have also been watching these markets. What are your thoughts here as we get close to Monday? Brian, Monday expectations.
I think we're going to be selling off after Monday. I think what we're seeing are the commercials buying what they need in front of this report. They're building that pipeline back up, and they are getting situated. If they have to take on a bullish report, they're comfortable with the pipeline, and it's going to leave it for the non-commercial crowd.
All right. So we've got...
You know what? Follow-up question, though, Brian. If this is a sell-off after Monday, like you say, how long does that last, and ultimately are we going higher? If we are going higher, when is that going to happen?
Well, that's going to depend, one, if we're going to see what kind of panic selling. Are producers going to sit in the bin and leave those bushels in the bin, or are they going to start going off into a panic? Or what is going to be the case here?
Yeah. That's the concern. It might all come back to harvest. We might have to see what the bushels are coming off the combine. Ted, you mentioned, let's say we print a 1.7 on Monday. Mm-hmm. Market's trading a 1.9. Right. How long do you think until we get a bearish reaction on Monday? How long until the trade goes, all right, it turns out maybe that wasn't the worst news in the world. We got to bring our expectations a little bit lower. How long do you think it takes to turn the market around?
Yeah, honestly, it could be one of those things where we get a 20-cent knee-jerk reaction lower, And then by the end of the day, we're creeping back to unchanged, only to be higher on Tuesday. And it could be a tremendous turnaround Tuesday this year. I think as the dust settles, those of us that know what we're looking at will realize, hey, this is a big step by the USDA to happen on our August WASDE report. We really don't know how acreage is going to end up. Again, this is still just a survey. We don't know how we're going to make it. We don't know what weather is going to be like in September. We don't know if this corn crop's going to make it. There could be 20% of this corn crop that doesn't make it. So I think if it is a knee-jerk reaction lower because of a miss based on these, I'm going to say, wild expectations, I think we come back pretty quickly. And again, the soybeans are the wild card. If the soybeans get a bullish report, corn might not even spend hardly any time. So a 20 cent lower, knee-jerk reaction lower on this corn report, that actually might be a buying opportunity for corn or a re-ownership opportunity for producers. I think it could be fairly short-lived if we really do knock this corn market down on Monday. But I do think there is certainly that chance for a big negative reaction shortly after the corn report. One last thing. Keep in mind, the last 3 or 4 reports that we've had have had these really wild knee-jerk reactions that happen in the first couple minutes of trading, and then we fade and go the other way. I wonder if we're going to see a very similar thing here on Monday.
Now, with regard to soybeans, Ted, for our growers who are planning on using Monday as a marketing opportunity, let's say we get the bullish bean report. Where should guys have offers? What should they be thinking here? What could bullish be?
Yeah, so I just got done interviewing a guy on AgriTalk, and not as bullish as I am in soybeans. So he was suggesting that we should have Darren Newsom, by the way, suggesting that we should have selling points 30, 40 cents higher. I'm not going to argue that if you have a strategy like what we were talking about earlier in place that would kick in and take over and help replace the profit potential on the bushels that you're selling. That's fine for me if that's the case. If you don't have a strategy like that in place, however, I don't know. I really don't think 30 or 40 cents is enough for me for soybeans. I still think that we're going to take a shot at 10.25 minimally for soybeans based on what I know right now. So where do I have orders to sell soybeans? Upwards of 9.88 and higher. Okay. And I'm going a little farther out than November, so I'm talking January beans. And listen, I think you should have those orders in there waiting. That being said, the re-ownership strategies, they're inexpensive right now. I think this is a great way to play the soybean market and look for that pop to make some cash sales.
Dan, what are your thoughts here? Monday, we haven't heard from you. You're making notes. You're thinking. I can see your brain working. What are your thoughts on Monday as we get prepared for this report? How should growers be anticipating or acting before the report comes out?
Well, like any big report and any big news event, we're not here to gamble on the outcome of it and to pick a direction even in that regard. It's all about risk management at the end of the day. And we know that news has a high propensity to cause change in the market. It is the fuel on the fire, so to speak, that markets will use to tear through stops above highs or below lows. And like we saw in the last WASDE report, corn traded 30, 40 cents higher before reversing and putting in almost, if not a limit down day. And it was one of those eye-opening reminders that even corn even corn markets, when the news and the geopolitical situation is right, can attract that level of volatility. So at the end of the day, the expectation should be for markets to be moving, for there to be a high propensity for change. And whether or not you think they're going higher or lower, remember this is a game about managing risk, and at times that means having to take a step back and watch from the sidelines.
That is what it means sometimes. But folks, we don't want to take up your whole day. We know you are very busy people, and we really appreciate you taking the time to listen to us here at the Zaner Group. We will be doing these monthly before every USDA WASDE report, so stay tuned. Save our number. Save that registration page. We want you coming back, and we want to hear from you. What are your thoughts? What can we do better as we get there? Because at the end of the day, we agree that not one size fits all. You heard that from Ted, you heard that from Brian, you heard that from Dan. Every operation is different. We want to work with you and find a bespoke system that will help you manage your market risk. We are an educative brokerage. That is how we operate. That is how we approach the markets. We want to work with growers. If you don't understand trading, that's totally cool. You understand production. We understand trading. Give us a holler. Let's have a conversation. To that end, you can find us everywhere. As I mentioned, Ted literally just got off doing Agri-Talk this afternoon, and then he jumped right in to be on this conference call. You can hear our folks anywhere, all the time. We want to be accessible to you. And to that end, give us a shout. You can reach us at any time at the office at 312-277-0050, or if you're watching on the internet right now, you can see our Twitter handles up there. Ted is at the Ted Spread. Brian is at Ag Hedge Brian. Dan you can find at Daniel Hussey Jr. And I am on there at Pearson Cattle. And before we let you go, folks, one final reminder that trading futures and everything else involves substantial risk of loss and may not be suitable for all people. You can read the disclosure right there. We got to put that in there. But folks, thanks again for taking the time. We appreciate you joining us on our very first webinar here at the Zaner Ag Hedge Group. Stay tuned and stay caught up because we will be doing these each and every month, and we'd love to have you be a part of them. Futures trading is speculative in nature and involves substantial risk of loss.